Hey guys, welcome back to another episode of this options trading series. This is episode 2, and in episode 1 we had discussed the buy call strategy, and in this episode we will study about the bull call strategy. This is a similar strategy. The view is a bit similar to what we had in the buy call strategy, but the difference here is that the strategy has two legs and your cost is lower and your maximum profit is not unlimited here. It is limited and it is known. So it's like you're bringing down your cost and you're buying an insurance so that you know your risk to reward in a better way. So I would say personally, I feel that this strategy is a better one than just doing naked buy call options. So let's go and let's discuss the strategy. So the view in this strategy is bullish, similar to how it was in our first strategy. But the only difference here is that your view can be a bit moderately bullish because your cost is coming out to be lower in this strategy because you are selling an option, and I will tell you how you can sell the option and how you can build the strategy later in the video. But yes, what is our view in the strategy? Our view is bullish, but it can be a bit moderate than the first strategy. So your view in this strategy is bullish. So the second step is how to choose the expiry when I'm deploying my bull call spread strategy. So whenever I'm deploying this strategy, I like to give 2 to 3 weeks time for my view to work out. And for that reason, I choose expiries which are 2 to 3 weeks further away, because here time is also not my friend. So the closer I choose, the more risk is there that my view won't work out. And also as time passes by, the value of the options melt away. And for that reason, I choose 2 to 3 weeks further away expiries when I'm deploying the bull call strategy. So again, I will show you the example of how I deploy the strategy on Nifty as I did in the first episode. So let's go. Right now, Nifty is around 16,940. 16,940. So if I choose 16,940 and if I want to deploy the strategy, so I will build this strategy. So now the strikes which I have to choose, we will discuss that later. But firstly, let's discuss how to choose the expiry. As I told you, I take 2 to 3 weeks further away expiry. So let's take 13th April expiry here when I'm deploying the strategy in the market. So in the starting, I told you that a bull call spread has two legs. So what do you mean by two legs? In two legs, we mean that we will buy a call option, buy a call, and also we will sell a call option. So what option we have to choose and which strike to choose, that I will explain to you here. So we have decided that 13 April is our expiry because we are taking 2 to 3 weeks away, further away expiry. Now discussing that which option strike should we choose. So what I prefer to do is for buying the option, so the buy leg, I take at the money or in the money. That really depends what is my plan, but I don't take out of the money. So out of the money is a big no. Yes, when you choose out of the money, I will show you that your risk will be lower. Your risk reward might be higher. And because your risk is lower, because the premiums of your buy option is lower, so your risk is lower, but the probability of you getting the strategy right would be lower. So I personally prefer choosing a strategy which has a higher probability of profit. Yes, the risk will be higher on that, but my probability of profit is what I want to be higher. For that reason, I only choose in the money and at the money. So let's go and let's see. So let's take an example that our view is Nifty is bullish. Again, I'm telling you that this is just to show you the strategy. This doesn't mean that this is for sure the strategy which one should deploy in the current market scenario. This is just for educational purposes. So let's take an example and let's see that we are bullish and we think that Nifty will go higher from here. So we will take at the money option. So let's take at the money. So at the money right now will be 17,000 is at the money. So we will take the 17. So at the money delta is approximately 0.5. So let's take at the money here. So the at the money option here will be 17,000. So we are buying the 17,000 option. Now let's discuss what should be the sell strategy. So the sell one can be two parts of it. So the sell could be that price where you think your target is. For example, if your target is that Nifty from here will go towards 17,200. So you could sell the 17,200 call option, or at least take 2 to 3 strikes away. So 1, 2, 3. So at least take 2 to 3 strikes away. So I would say here we can take the sell one as 17,150. For example, my target is that 17,200. So 17,200 is my target. So let's take that. So 17,200 I say is my target. On my strategy on Nifty, I am assuming that Nifty will go above 17,200. So that is my target. So I take that as an option, or at least give 3 strikes gap and then sell that option. Because what are we doing here? So let's see what are we doing here. So the main aim here is that when we buy this option, so let's say that we buy the 17,000 option, 17,000 call option we are buying at, what is it at? 217. So we are buying here. But against that, to bring down the cost, we are selling the option of 17,200 call option at how much? 17,200 is trading at 124. So what will be our cost? 124 minus 17, that is 93. So 93 points is our cost. So 93 into 50, because one lot is 50 shares. So 93 into 50 will be our cost of this strategy. So let's go and let's deploy this strategy. So your risk here is how much? 46,693. That is the 93 points that you have given to the market. Your total net premium was 93 because 217 minus 124 equals to 93, and into 50 is your max loss. So this is the maximum that you could lose. But if in the first strategy when we looked a naked buying option, this was unlimited, but here this is also limited. So your max profit is also limited. Now if you say that the risk to reward that you are risking 4693, so you are risking here 4693. So if you see, the risk to reward is not that good. You are your profit which you could get is 5308 and you're risking 4693. So your risk to reward is not that good in this option. So you might say that your risk to reward is not that good, which is 0.88. So yes, this is there. When you are choosing at the money options, your risk to reward won't be that good. But let's see what will happen. So right now your break even is 17. On this strategy, on the first strategy, when we are taking at the money buy option, your break even is 17,904. 17,904. Now let's take out of the money option and let's make a strategy with that. See, now your break even goes higher. Now from 17,094, it has gone up to 17,145, and your probability of profit has also come lower. Previously, your probability of profit is 43%, but now it has come down. When you choose out of the money option, here out of the money will be 17,100, and your then 38% is the probability of profit. But yes, your risk has also come down, but I personally don't see that your risk should be lower. I personally believe that I want to deploy a strategy wherein my break even is lower and also my probability of profit is higher. For that reason, I always choose at the money or in the money options. So this is the strategy which we have deployed, and now later slowly I will show you that what will happen with this strategy. You would need approximately 23,000-24,000 to deploy one lot of this strategy. If you multiply it by multiple lots, you'll have to multiply 22,000 into the number of lots that you decide to deploy. So this is the strategy which I think your risk is lower, and it's way better strategy than doing a naked option because you are hedged. Even if you go wrong, you already know how much money you can lose, and the power of that knowing how much you can lose is very high. And if you ask me, you can say that yes, this risk to reward is not good, but I'm going to show you how you can bring down the max loss as well, so that you don't lose all your money and you can keep a lower maximum risk as well. So let's go and let's look at the payoff diagram now. So now let's go and let's say that on the charts when I go, I see that 17,835 is the level which I think is the support. So let's say that 16,800 is the stop loss level wherein I think if it goes to that level, I will exit, because I will know that my view hasn't worked out and Nifty is not bullish, it is coming down. So 16,800 could be the stop loss level for you. And let's say that 17,200 is what you are looking at. So now let's say that 16,800, we look at the payoff. Let's say your price goes to 16,800 and it goes in the next, by April 2nd, imagine April 3rd, imagine that the price has gone to 16,800. What is your what is the risk that you're getting? 2,000 rupees only, and you're on expiry. If you hold it till expiry, then you will lose all your money. But if you keep a stop loss, then your risk is only 2,000. So if you keep a particular level that, oh, if it goes to this level, then I will exit, then you have a lower risk, and then your risk is 2,000. Imagine this is 2,000, and you are saying that you might get 5,000. So your risk to reward then comes out to be better. Now let's say that same date, we say that it goes to 17,100. So if it goes to 17,100, you will be making 1,000. So this is there that if it goes up, yes, your profits won't come as fast, but yes, it is better because your risk, is capped, and how much money you would lose, and your cost on this strategy is lower. So that is a very powerful thing in this strategy, I think, because your risk and your cost is lower of deploying this strategy. Now let's say it goes to 17,200. It goes to 17,200 and it is third. So if it goes to 17,200, then you're making 2,000 rupees. And on expiry, if it goes to 17,200, you will be making 5,000 rupees. So the payoff works as such that the higher strike which you've chosen on expiry, if the price is above this level, the sold strategy which you've done. So 17,200 is your sold option which you sell. So if it goes above that, then you're making maximum profit on this strategy. So the payoff is as such that on expiry, if the price is above 17,200, which is my sold option, then I will be making maximum profit. So the maximum profit on this strategy is above the sold option. That is why I told you that it is important to keep the target as your option which you are going to sell. So this is how the payoff works for this strategy. So yes, you need to have particular rules, and you need to follow those rules if you want to be profitable in this strategy, because time is not your friend when you're deploying a bull call spread. So whenever you deploy this spread, you need to have a particular rules for yourself, and you need to follow those rules. And the rules are as such. So you need to have expiry that is at least 2 to 3 weeks away from the current expiry. The strike which you choose is because this is a strategy which has 2 legs. So you need to choose a buy. We need to buy the at the money option or in the money option. And then when you sell the option, that should be either whatever your target is on the particular strategy which you are trading. For example, here I told you that 17,200 is my target, and then I would sell the 17,200 option. Or you could at least take 2 to 3 strikes out of the money option. So it could be 17,150. If you're buying the 17,000, then your strike could be 17,150, 17,200, somewhere around that. And then you have to exit the trade 3 to 4 days before the contract expires. Same rule that we applied in the first strategy, which was a naked buy strategy. And then you can the only difference is you can hold this strategy till expiry if the price is above the option which you've sold, because a max profit will happen when the price goes above the sold strike. So for example, here our sold strike was 17,200. It was the strike which we held, sold the call option, and once the price goes above that on expiry, then we have a max profit. So if you have the leverage to hold it beyond a certain point till the expiry and it has gone above the strike which you've sold, then yes, you should hold the strategy. Otherwise, you should exit 3 to 4 days before the contract expires. And fourth is the stop loss. How to keep a stop loss? As I told you, it could be on the charts. Whenever that support is broken, you exit the trade, or either how your maximum profit here was around 5,500. So always focus on getting a risk to reward, which is 1:2. So for example, if you're getting a max profit of around 5,500, then you should keep a risk not more than half. So for example, 5,500 is your maximum profit and half is 2,750. So your maximum risk shouldn't be more than 2,750. Whenever you start seeing a loss in the strategy, which is more than half, then you exit that strategy, and the half price comes here at 2,750. So for example, it goes to 3,000. Then if I deploy based on my risk to reward, then I would exit this strategy. So here were some rules which I want you to focus on, and if you follow these rules, then there is a likely chance that you might be successful when you're deploying this strategy. Now my verdict on this strategy. This is a strategy which I could consider using when I'm super bullish on the trend, and I think the trend is quite bullish. So I personally would prefer deploying this than rather going for a naked option strategy. So I wouldn't go for the first strategy whenever I am bullish. I would prefer this strategy because I like how I know my risk to reward, how I know my maximum risk and maximum profit. So this is a strategy which I think is something which I consider whenever my view on the market is bullish. And to get more updates like this and more strategies like this, do follow Uday Trades and also subscribe to the channel. Do like the video. Thank you.